All right, Bryce. Well, people aren't listening to this podcast for our analysis of aviation history. Save that for the separate podcast on the separate feed. Let's get into the investing chat because there is a lot going on and a lot we want to cover today. Producer Sascha is going to be joining us, and she's got a question about the owner of Formula One. We're going to talk about the world of luxury conglomerates because LVMH, Louis Vuitton Moët Hennessy, has really taken the world by storm. Second most valuable company in Europe. It's created the world's richest man. But there are other luxury conglomerates that are emerging that are worth talking about. But first of all, let's talk about the news. Let's talk about what's going on because we are once again in earnings season over in the US.
We are, Ren. It never stops. Well, it feels like it never stops. Happens every quarter. And the story this quarter is almost no different to every other quarter, which is big tech keeps on growing.
Yeah,
chewing up the market. It's
wild how we had like a year where there was panic across big tech. Well, not even panic. Yeah. It's a relative term, isn't it?
Yes.
Yeah. But to be fair, like Meta, Facebook fell 70%.
Yeah, that's fair.
Like there was panic.
Yeah, but that was also because of they were going through a few, like the spending on, there were bigger things at play for them. Like what did Alphabet fall during that period? Definitely not 70%.
Yeah, Spotify fell 80%. Shopify fell like 90%. Like I know they're not big tech, but
they're techie.
There was blood on the streets.
Well, they're back, that's for sure.
Yeah. Let's go through some of the big numbers from the biggest players. And then I want to ask you how it's affecting your investing.
Okay.
Microsoft, profit up 27% from the same time last year. Alphabet, Google, profit up 41% from the same time last year. The story really emerging is around their cost cutting that they did in 2022. So Alphabet revenue grew 11%, profit up 41%.
Love to see it.
Yeah, that's a story of improving margins. Meta.
That's a story of firing 11,000 people, isn't it?
Yeah. Yeah.
Yeah. Or however many it was.
Yeah. Meta, they reported a really impressive set of results. Revenue up 23%. Profit doubled from the same time last year. And that was their operating margin improved from 20% to 40%. Again, that's a story of firing tens of thousands of people. But here's the most notable stat, or the one that all the analysts were waiting for. Threads, just under 100 million monthly active users.
Yes. What's that? 10% of how many are on Instagram these days?
Over a bill.
Yeah. Okay. You're one of them.
Equity Mates is one of them. Come join us on Threads. Join the conversation.
I feel like Threads had an incredible few days when it launched.
It had an incredible few days.
And now it's fallen into the abyss. Might be coming back. I don't know. I'm not on it. I mean, I'm on it by nature of being on Instagram, but I'm never actively looking at it or engaging in it in any way.
Do you get the thing on Instagram now where it's like, here's the conversation happening on Threads, and you can like scroll across?
Yeah.
Yeah. Smart by
bad.
them. Yeah. And I always hit the see more because I want it to just expand the box in Instagram, and it always takes me to Threads.
Damn it.
I wonder how many of the 100 million monthly active users are just people who hit see more and then quickly get out of it. Yeah.
So yeah, it's pretty impressive. I'm seeing here that because revenue, Meta have just reported at time of recording, it's their fastest rate of revenue growth since 2021, an increase of 23%.
Since 2021, 2 years ago.
I know. So I mean, they keep on chewing away. There's obviously this ties. Well, not obviously, but you can see why there's so many of these companies, and we spoke about it last week, are in antitrust and I think Meta's been now sued by 41 states or something for, what was it, for the harm that the social media sites are doing to children?
Yeah, addictive platforms and stuff like that.
They had copying it from all sides.
I'm not a legal expert. I'm not in the States. But the idea that unless they've know something, unless there's something, but it's like every tech product is designed to be addictive in some ways. Like
the like buttons,
even, like the colors that they
colours,
use,
yeah.
like it feels like it's a Pandora's box that can't be opened. I mean, like half the food on our supermarket shelves are optimized to be addictive. Like,
that's true.
I mean,
Sue Kellogg's.
Yeah.
Anyway, I think something of interest is the battle between Alphabet and Microsoft when it comes to cloud. So Alphabet, better than expected overall results, as you pointed to. However, they missed a little bit when it came to the cloud revenue part of the business. They also are up against Azure, which is Microsoft's cloud business. And Azure's cloud revenue growth has accelerated after 2 years of deceleration. So,
what about Amazon?
Well, they're the market leaders. So,
haven't reported yet?
I think Amazon actually reported in August. Pause there.
No, yeah, they might have, but that was the last quarter. That would have been Q2. We're into Q3 now.
Blowout profit beats. This was on the 3rd of August. Yeah, okay. So we're probably expecting
so that
maybe end of November.
Maybe they'll report
in a couple of months, in a couple of weeks. So we'll watch that anyway.
It's non-stop.
It's non-stop.
All right, so big tech keeps getting bigger. Not really a surprise there. Or also one other company we have in the notes that we didn't talk about, Spotify, turned a profit after a brutal 2022. They're 23 million euros in profit. Last quarter, they lost about 250 million euros. So good turnaround for Spotify. Thought it was worth acknowledging. Are you going to do? Has anything that's happened this earnings season changed your investing philosophy?
Well, I'm glad about the Spotify results because I'm a hodler of Spotify.
Yeah.
I'm pretty sure I'm still under on them.
I also am still under on them.
I'm happy about Microsoft and Alphabet because I'm both of those. I will probably take this opportunity to top up on Alphabet a bit. If looking at their stock price, they're down sort of 10% since a peak in October, only a few weeks ago. Might take that, but no, it doesn't change anything for me. I'm exposed to all of them. They're keeping. I think if you look at, there was an interesting chart that we released on Instagram. If you want to go and have a look, we put charts out every week, and it showed the impact that these big tech companies have on many of the indexes. And just by nature of being in the indexes, you're getting the benefit of these results. So it doesn't change anything for me. What about you?
Nah, I mean, keep on keeping on. I think Alphabet is my biggest single stock position, and nothing that we're seeing would change that.
Yeah, and you got in on Meta when it was a rock bottom.
Yeah.
So can't
pretty happy
complain
with
that. Have you added to that position?
No. Okay. Yeah. I'm not and there's a chance that I sell it at some point, but not now. Yeah. Let it ride. See what happens.
All right. Well, let's keep moving, Ren. Americans are falling behind on their car loans.
Yeah, now this is a stat that you're all over. This is a story that you've been watching for years.
Yeah, I've got it up in the office.
Americans, so it's the highest rate in 3 decades. 6.1% of car loans are now more than 60 days outstanding, according to Bloomberg. Which is the highest since they started recording it in 1994, or the highest since 1994. And it's just another indication of economic stress.
Yeah. Higher rates, higher borrowing costs, squeezing consumers essentially.
Yeah. And for years, this has been a story that's been bubbling in the US, and it's never come to anything. The global financial crisis there were a lot of subprime mortgages that were then packaged up and then sold on to investors. And then as those mortgages started to fall, then the bottom fell out of the financial system. The same thing happens with auto loans, that they, the loans get originated by car companies and third-party financiers. They then on-sell those loans. They get packaged up by investment banks and the like, and they get sold to investors. For years, people have been like, oh, there's systemic risk in America's auto loan sector. And it's just never come to anything. And it may never come to anything, but it's worth being aware that there's more loans in arrears than...
Yeah, well, this is like not the first, but this is a strong indicator of the impact of interest rates and maybe more of what's to come more broadly across society when borrowers, this has impact then that goes into them spending in the economy. And this is essentially what the RBA wants to, not the RBA, the Fed and the RBA wants to happen. Stop people spending, stop people borrowing, stop people, I guess, heating up the economy. Yeah. So it is unfortunate if for people in this situation and getting their cars repossessed, but it's signal of more things to come, I think.
Well, you'll keep your finger on that pulse because it's a story that you're very interested in. But speaking of the RBA wanting to stop people borrowing and to slow down the economy, as a recent borrower of an undisclosed amount, yes. But as someone who's bought a house a couple of weeks ago, how are you feeling? Any updates that you want to share with us?
We're in the midst of now moving.
Have you signed on the dotted line?
No, this is the bloody annoying thing. So you get the contract, and then as part of the contract, you need to set up the offset account, and you need to put all the sort of information in where you want the money to be debited from and all that sort of stuff. To set up the offset account, you need to ring ANZ, or because I'm with ANZ, or go to a branch.
Not sponsored. Would take a sponsorship.
Go to a branch to set that up, and Harriet needs to be with us to do that.
Have to go to a...
Well, you can call. You can call or go to a branch. To then do it online, to do it over the phone, you need to be digitally verified, which it's like, surely by now, after the months of pre-approval and the application and everything, we've been verified.
Yeah.
No. So I'm an ANZ customer, so I have been. Harriet's not. So it does the digital verification. We're now 4 days into that, and they still haven't digitally verified Harriet.
What, is it just like send us a photo of your driver's license?
Pretty much.
Okay.
Yeah.
Sportsbet can do that in like...
You would think AI should be able to rip that off and just be like, yes, this is Harriet.
Surely these days you could just connect with MyGov or something like ATO. Like there's a... Yeah, anyway.
It's unbelievable. So we can't set the offset account up until she's verified. We can't sign the docs until she's verified. Then once you sign the docs, you have to post it to ANZ. Yeah. Then
that one I'm not surprised by. Like signing in wet ink for buying a house makes sense.
Yeah.
Yeah.
So there's a few things still to go. So long story short, no, we haven't signed on the dotted line. But that's the final hurdle. Hoping that we do, because I'm getting rid of furniture at a rate of knots from our apartment at the moment. So if it falls through, we're going to be living bare bones.
Okay.
But anyway, back to I have been given my interest rate. So I know what that is, 5.84. Which was lower than we thought, which was nice.
So side note, someone in the office was telling us that they're about to roll off the interest rate cliff, the mortgage cliff. Their interest rate had a 1 in front of it. Mm-hmm. Can't remember exactly what it was, like 1.4, 1.7 or something. It's going up to 5.8.
Holy shit.
Doubles their mortgage repayments.
Wow. That hurts.
Yeah.
Yeah.
So how does that... how do you guys think about fixed fee variable now?
All of the professional advice we've been given has been to stay variable, because the consensus in the finance is just like whatever. But the consensus is that while the short term may result in some interest rate increases from the RBA, we know that inflation is not where it needs to be. That the longer term, over the next 3 years, the period that you would fix, there is a higher likelihood that it'll simmer or there'll be some rate cuts. That's what we've been told from a professional point of view. Yeah. So where does that leave us?
You just have to hope that Christopher Joy isn't right. And for people who missed his interview on our podcast, definitely worth listening to. But he thought there's a whole nother hiking cycle to come.
I know. That
it's like
that would be freaky.
It's like fixing caps your downside. Like you might miss out on some of the upside if there's a cut. I don't think it's likely that there's a cut, especially with inflation numbers where they are. The Fed had said there'll probably be one more rise by the end of the year.
It's a good point. Like I honestly haven't.
You're just like Mr. Conservative most of the time. I would have thought you would be like, I'm going to I'm going to err on the side of certainty.
Well, I think because what we've factored in is like if rates do a Chris Joy and go to double from here, what are they now? 4%.
4.1.
If it goes to 8%,
you're fucked.
We're in trouble.
Everyone's fucked. Like we laugh because you've bought a house. I'm trying to buy a house, and that scares us to death.
That would be if they do what if RBA says is sort of likely, which may be 0.5% over the next year or whatever, like we can handle that. That's been factored in. And so for me, I kind of look at it on the other side. It's like, to your point, the downside's capped. The upside is that we get a bit more cash flow. But you know what? It's made me think about it a little bit more.
All right. Well, let's open it up because everyone has opinions on housing, and as two rookies who've never waded into this world before, there's a lot of people with a lot more experience than us. Join us in our Facebook discussion group, Equity Mates Investing Podcast on Facebook, and join the conversation there and give us your thoughts because we actually genuinely need advice.
Hey, Equity Mates. So just jumping back in here, we finished recording and I had received a message from my mortgage broker around the fixed v variable interest rate. Now, Ren, here's the interesting thing. So I'm with ANZ and they've said that ANZ's 1 year fixed rate is actually currently 6.34%.
Oh,
so you're
okay.
Get
and and for context, your variable is
5.84.
Okay, so it's like 50 basis points higher.
Yeah, and then on top of that, for the variable component of the loan, because you can't fix the full loan, you only fix a portion of the loan.
Okay, yeah. It's
0.45% higher than my current variable rate. So I'm not ever going to get the variable rate the way that's how I'm reading it anyway. So he said, so for there to be a benefit of fixing, there'd need to be 2 rate rises with no rate cuts over the next 12 months.
Right. Okay. And I think before we turn the mics on, you said you can also fix at any time.
Yeah, so that was my question to him. I just said, out of interest, can I fix my loan at any point in time?
So if you get a sniff that, Chris Joy might have been right and there's another rate hike cycle coming, not just 1 or 2,
yes,
but it's like,
we're going to 8%.
We're getting another 12 rises in 13 months again.
Yeah.
You can be like, all right, flick the switch, fix me.
Yes, he says once your loan is up and running, you can fix at any point in time.
Can you fix multiple points? Like, could you? I don't know why you would, but like...
What do you mean?
Like fix for a year, variable for 2, fix again.
Probably. I don't know. I can ask him. But he also says, while no one can predict accurately what will happen with rates, his gut feel is that it'd be better just to keep on variable and ride out any interest rate rides and hope that some rate cuts occur.
Yeah, well, I mean...
So let's leave it there.
Yeah, okay. The strategy is hope. All right, nice. All right, let's move on because there's a lot to talk about. Let's take a quick break here. And then on the other side, we're going to talk about the owner of Formula One that is listed on the stock market. Producer Sascha is a shareholder and has a question about them. All right, welcome back to Equity Mates. We have a special guest in the studio, Sascha. Is your mic working?
It is. I don't know whether I'm a special guest. I'm like a long-time lurker, first-time talker, right?
I don't think first-time talker.
Yeah.
Oh,
if people listen to the dive, they would be very familiar with Sascha. And if you don't listen to the dive, you're missing out on some of the most interesting stories from the world of business and finance.
Yeah. What are you doing with your Mondays, Wednesdays, and Fridays if you're not listening to the dive?
Yeah, so head across there and listen. But Sascha, you normally speak to the Equity Mates community and get listeners to jump on the podcast and ask their questions. But you said no listeners this week. I'm putting myself at the front of the queue because I have a question that I want to talk about. So the mic is yours.
Yeah, absolutely. I just shoved a whole list of people out of the way. No, I asked this question at a meeting and then we were like, well, why don't we talk about it on mic? So I'd say when we went to America, I would say I was lightly bullied for admitting the fact that I checked my portfolio every day. And you guys were like, don't do that. That's bad.
Yeah.
So
Lightly bullied.
So I went cold turkey and I was like, okay, I'm not gonna check it for a couple months. And then I logged on recently and I was like, hang on, where have these two random stocks come from? I have no idea what's going on. And so I bought a position in Formula One last year. Not a huge amount, but like obviously not obviously to anyone who doesn't know me, but I am a big Drive to Survive fan. I read that Warren Buffett bought into it, and I just thought it was a good idea to back my interests. So I've got FWONA, that's the ticker for Formula One.
Yeah, and the company isn't called Formula One; it's called Liberty Media Corp Series A. But yeah, they own Formula One.
I knew it had a confusing structure because I listened to our Summer Series episode on it. So I knew that I was buying the one that is responsible for the Formula One kind of stuff. But then when I logged in, I have like $4.11 of a company called BATRK and $5.18 of another one, LLYVA. And I guess this is kind of my responsibility for not having paid attention to any of their company announcements, but I just was like, what on earth has happened? And now what do I do with these two random stocks? So yeah, that's basically what I want to workshop today.
Nice. Well, first of all, we need to be clear to you, Sascha, and to everyone listening that everything we talk about is general advice only and not personal advice. And whilst we are licensed, we're not aware of your personal financial circumstances. And Sascha, to the extent that we are aware of yours, we're not going to talk about them. We're just going to talk about the companies. So I think let's start with what all these codes mean. Because we're talking about perhaps the most confusing corporate structure, at least in America. Europe has some doozies over there as well.
Yes. Firstly, if you want a deep dive on this, go back to our summer series from last year. We did a deep dive with Andrew Brown on all things Liberty Media and the fascinating story behind it and the founder. But let's clarify a few things here. So let's start with the stock ticker that you have in your portfolio. Well, you have all three, but the main one there, Sascha, which is F1A or FWONA.
Yeah.
It is the Liberty Media Corp Series A stock. To confuse things, there is also F1B and F1K. So 3 different classes of shares. You've got Series A. We all love Series A. And it is the company that owns Formula One.
Do we all love Series A?
Yeah, love Series A. Series A, Berkshire, Series A, Microsoft, Alphabet. You want the Series A.
Okay. So
there is no logic behind that.
Yeah, okay.
So then, Sascha, you said you had a look and you saw 2 others. You had Batter K.
Yeah, Batter K.
It's the Atlanta Braves holding company. Now, the Atlanta Braves are a Major League Baseball team. And so this company owns the Atlanta Braves baseball team. So congratulations, you're an owner of the Atlanta Braves.
I'm famous for my sporting prowess. Now I have baseball. Cool.
Yes. Cool. Next minute, Sasha's wearing an Atlanta Braves hoodie to the office. And so similarly, they also have a Series A and B stock. So there's the Batter RK, Batter A and Batter B. And then finally, there's the LLYVA, and that's the Liberty Media Liberty Live company. Now, they are a company for Liberty Media's 30% ownership stake in Live Nation. And Live Nation own Ticketmaster and Live Nation, which is a touring company. You might see that they would have partnered with Taylor Swift and the like to tour these big acts. So you're a part owner of that. And similarly, they also have subclasses of stock, Liver A, Liver B, and Liver K. Wow.
Okay. So let's take a deep breath because this story gets even more confusing. But let's talk about Liberty Media. So controlled by John C. Malone, who's like a big billionaire, came up in cable TV, was the CEO of TCI for about 23 years. And then through a number of corporate actions, he ended up controlling this company called Liberty Media. Rather than just having one stock ticker and just one company and being a conglomerate, they control all these different companies but split them out and then split each company they have control of into 3 different share classes as well. So that's why it's so confusing. But essentially, Liberty Media own the Formula One. They own the Atlanta Braves. They have a 30% stake in Live Nation. And then they also own Sirius XM, which is they have a major stake in Sirius XM, which is a digital radio platform. And so you can buy all of them separately. You can't buy Liberty Media, the parent company. Like, that's not listed.
It's not up for grabs.
Which makes it even more confusing. But this is just the current structure. And over time, Liberty Media buys and sells companies. And then they also join together and split out different companies. And so, Sascha, to get back to your original question, which is why the hell do I own part of the Atlanta Braves and Liberty Media? It's because you already did have an ownership stake in these through your Formula One. And now Liberty are splitting those out into separate companies.
So it's not like I've been paid a dividend in the form of another company. They've actually decided to split these out and give me my share owning
title
as a separate title.
Yeah.
Okay.
So just like Woolworths demerged Endeavour Group, and if you owned Woolworths, you then got shares in Endeavour. This is John Malone and his team splitting out the Atlanta Braves into a separate holding company and splitting out Liberty Media, their ownership stake in Live Nation into Liberty Live. Okay. So I guess the obvious question before we get into what you do is why do they do this?
Because it usually nets, this is just my assumption, well, probably historically it shows it as well, but it usually nets in a better valuation and company performance from a shareholder point of view for each of the individual companies. We even spoke about this last week when it comes to splitting up some of the big tech companies.
Yeah.
You might find that now the Atlanta Braves as a separate holding company, from a shareholder returns point of view, is better off being separate than if it was still tied up in Liberty Media.
Yeah. Yeah, it's like if you've got a great asset, you don't want it diluted in a big conglomerate. And then similarly, if you've got a dog of an asset, you don't want it dragging down the...
Which is why Wes Farmers got rid of Coles. Dog of an asset. They wanted to keep
it honestly could be why they split out Live Nation. Because Live Nation is seen as a monopoly on ticketing and touring. Everyone hates Ticketmaster. And there's probably going to be some regulatory moves to split them up or to control them in different ways, and it might be let's get them away from Formula One. Yeah. So I guess the question is, Sascha, what are you going to do with them?
Well, I guess now you've clarified that, because the whole thesis of me buying it was for Formula One. Obviously, I know nothing about baseball, and and definitely I have as a Taylor Swift fan, but I have pretty strong feelings about Ticketmaster and Live Nation. We did a dive episode on it and stuff, and I'm not 100% sold on the direction that that's going in. So it just makes it clear to me that the core of my thesis is kind of, I don't want to say the word pure, but it's it's kind of the reason I bought into FWONA was for Formula One, and now it's just more of Formula One. So it's kind of okay for me. But now I just have these random, I guess the point was, I was is this going to happen again? Do I just leave them there and will it top up again? But if they're split off as completely different companies, I might as well just sell it and think about putting my $10 somewhere else.
Yeah. Well, I think if you do sell it, just be mindful of the cost base that you claim, because, you bought Formula One and now it's been split into 3 companies. So make sure you talk to your accountant about the way that you claim the capital gains or capital loss. But anyway, we're not here to give tax advice. The one thing to know about the Atlanta Braves is they're pretty good. So they actually topped the National League, which is their conference, and they lost in the playoffs. But
baseball overall is a sinking ship.
Is it?
Absolutely.
Ooh.
Yeah.
What's that based on?
I'll try and dig up a chart. It's fascinating. It just shows TV audience, in-game, at-game audience is just like almost at rock bottom, and it's been a slide for the last decade.
They need
Doesn't
one of their
surprise
stars
me.
to date America's favorite pop star, and then maybe it would all change.
True.
So the macro tailwinds, I think, behind baseball are not favourable.
Yeah. I want to close out this conversation around anti-conglomerates, because that's kind of what Liberty Media is, rather than being a company that builds a big empire and gets bigger and bigger.
Which is what we're going to talk about next.
True. They split these companies out, give investors choice if they want to hold or sell different parts of the empire. My stock of the year last year, IAC. Do you remember that?
Yeah.
Yeah. It's another example of an anti-conglomerate, and I think it's the best example of what these can become. You have to believe in management, and you have to believe in the assets, and there's certainly some dogs of assets that come out of these companies. But IAC, when Barry Diller took over in 1995, it was known as Silver King. It was trading at $39 a share. If we had bought 10 shares of IAC in 1995 and held until the end of 2021, those 10 shares of IAC would have turned into, well, you would still have the 10 original shares of IAC. You'd have 10 shares of Expedia, 4 shares of QVC, 5.5 shares of Live Nation, 0.6 shares of Lending Tree, 21.5 shares of Match Group, 10 shares of TripAdvisor, 6.6 shares of Marriott Vacations, and $59 in cash from an acquisition of Interval Leisure. And so all of that rolled up at the end of 2021 would have been worth $7,170, which was a 12% compound annual return from what you invested in 1995, which outperformed the S&P 500, which did 7%. It also outperformed Berkshire Hathaway, which did 10%. So, like, it's an interesting, if you find the right company, it can be an interesting investing strategy. These anti-conglomerates, which just like spit out shares of different companies in different industries with different prospects, and then they keep doing it over and over again.
Berkshire should do it now that I think about it.
Well, Berkshire's the complete opposite. It's the roll up, build the empire.
Yeah. They're the conglomerate.
Yeah.
Anyway, thank you, Sascha.
Thanks,
So
Bryce.
did we actually answer your question, Sascha?
I think you
Yeah.
did. I just feel a little underwhelmed with the fact that it's $10. And then you say that thing of like, oh yeah, but if you hold it, maybe this will roll out and this will roll out. So I'm just going to give some thought to what I might do.
But I think you've got to be careful. Like, they'll only roll out what they have. Like,
Yeah.
it's not like Liberty Media is just going to keep spitting out companies. It's it only.
And
in Melbourne, Albert Park,
Yeah.
and that'll be its own company.
Yeah.
And that Interactive Corp story was like 26 years in the making.
Yeah.
1995 to 2021.
Yeah.
Well,
But I mean, Formula, the story of Formula One, like, that's the story.
Yes. Yeah.
Like, that's the Liberty Media
I think
story
what you
now.
said, Sascha, is probably a good vibe, which is you bought it for the F1.
Yeah, I just think like they've just, or what is it, 3 new races in the US, Drive to Survive. I mean, yeah, maybe the show will start waning because it's already starting getting a little bit over the top, but like the number of fans that it's brought. And I went to F1 in Melbourne this year, and the money you spend to just be there for the day, I'm like, if that's happening all over the world, it feels like a good story to me.
I think there's more. So I don't own Formula One. I've certainly thought about owning it, but I think there's more sustainable tailwinds than just the Drive to Survive sugar hit. Sugar hit might be a bit pejorative, but the guy that used to own Formula One, Eccleston, what's his name? Bernie Eccleston. Yeah, he hated social media, and he refused to let any of the teams or any of the drivers share any clips on social media because it was like the F1's intellectual property. And even just the fact that Liberty are like, we want you to be front and center. We want these clips in the zeitgeist. Like, even stuff like that just just engaging with audiences as they should. Like, we'll bring so many fans beyond Drive to Survive and stuff like that. Just an openness to media, to recognize that sport is entertainment and to lean into that rather than to like gatekeep it as some, I don't know, old school motor racing club.
Yeah. But it should say before I go, I have hogged a listener spot today. So if you want to come and talk to the guys, just send us an email at ask@equitymates.com because, it needs to be someone. Yeah, because I'd love to have someone else talk to you guys next week.
Well, thank you so much, Sascha. And yes, please, if you want to ask a question, ask at Equity. Please, if you want to ask a question, reach out. We'd love to have you on the show. But Ren, that brings us to the end of today's episode. Plenty going on in markets. As always, it's great to chat. And we will pick it up tomorrow. Very exciting news. We're trialing a new show format, Buy, Hold, Sell, with Adam Kiley from Comedian The Economist. He's sitting down with Adam Dawes to go through some of the stocks on Adam's list that are a buy, hold, sell. It's an awesome episode, so make sure you tune in. Don't miss it.
Yeah, so we're doing 6 weeks of buy, hold, and sell. It will be coming out every Tuesday on the Equity Mates feed. And we want to get your opinions. We want to know if this is a content type that you like, how you would do it differently, and if we should keep doing it. If you guys love it, we will probably...
We'll do a Liberty Media and spin it off.
Yeah. I was going to say we'll create its own podcast feed, but maybe you and I take a day off or something.
That'd actually be really good.
Or we just keep releasing it on Tuesday on Equity Mates. Everything's up for discussion. We want you guys to help us make these decisions. So give it the first episode a listen tomorrow. It'll be then out on the next 5 Tuesdays after that. But the content train doesn't stop. We'll be then back in your feed on Thursday. Bryce and I are sitting down with Ellie Fordham for our latest Ask an Advisor episode. Another big week of content here at Equity Mates.
Love it.